Canadian Pacific is a railway company which is held by one of the super investors of our time, Bill Ackman, who has outperformed his peers over the last 5 years. Now, Bill holds over 10% of his portfolio in Canadian Pacific, Kansas. This stock, however, is down 4% year to date with a very small yield of 0.79%. What we want to understand in today's episode, is CP a stock we should be adding to our portfolio? Is there opportunity to see the share price double, triple over the next few years and see this yield increase to hopefully a yield on cost in the double digits over the next 5 to 10 years and beyond? We're going to take a look at the historical performance of the company, Canadian Pacific. We're going to jump into their income statements, looking at their top line revenue and bottom line net income growth. We're also going to look at their balance sheet, look at a quick health check, total cash versus total debt. We're also going to take a look at how they perform to some of their competitors, very popular companies, CNI, Canadian National Railway, CSX, Norfolk Southern, Union Pacific, and look at their total return performance year to date as well as the last 5 years. And we're also going to see what are institutions doing. Are they buying or selling CP? This is going to lead us nicely into the all-important dividend safety, some very important financial and dividend metrics you need to understand for this company. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, just because a super investor or an investor holds a company, it doesn't mean we should be adding it to our portfolio without understanding it and seeing whether or not we believe it to be a buy now. Year to date, though, down 4%, with investors who have held the company over the last 10 years would have seen a very strong 173% growth return on investment. This doesn't include those dividends reinvested. Nonetheless, very, very strong. And today we want to understand, can we expect the same over the next 10 years, and if not, significantly better returns? Now, it is towards the mid to lower end of the 52-week range with a yield below 1% and a forward PE of 26 or just shy of. And let's see how the company has performed. So income statement, what we typically like to see year on year is around 3 to 7% growth. December 2018, 5.3 billion on the top line. December 2022, their latest annual report, 6.5 billion. So there is some growth over the last 5 years. And on a more granular level, we can see the increase on revenue year on year. Although some years aren't particularly large, we will shortly look at the last 10 years percentage-wise too. But what we can see, the revenue is growing. Now, bottom line, how does that compare? Well, 1.4 billion reported on the bottom line net income. 5 years later, 2.6 billion. So again, the bottom line is also increasing in line, in fact, with the top line revenue. And we can see on a more granular level, the increases year on year. So a fairly consistent, essentially, company, which is always good to see. Top line and bottom line moving in the same direction, which is positive growth year on year. Balance sheet, total cash versus total debt. December 2018, they held around 45 million of cash on the balance sheet. Latest quarterly report, they are holding significantly more, in fact 10 times more cash on the balance sheet at 445 million. How does that compare to total debt numerically and directionally? Well, what we can see, total debt 6.4 billion in December 2018. Latest quarterly report, just shy of 18 billion, so almost 3 times as much growth of the total debt. Again, whilst we do see a 10 times increase in the cash, essentially is very small in comparison to the increase in total debt. So a slight red flag indicator, which we'll touch upon when we look at our financial metrics. Now, in terms of how they performed against their competitors in terms of total returns, including those dividends reinvested, well, year to date, it has been quite a difficult one for the industry. Canadian Pacific, roughly in the middle of the competitors, negative 3.5%. The best performing that we can see here is essentially FIP, closely followed by UNP and CSX. So not the best performed in terms of their competitors. And how does that essentially compare when we look at a wider period of 5 years, given the overall market year to date, bar the technology companies, haven't had the greatest performance. So 5 years, what we can see when we look at CP, it has in fact outperformed all of its competitors, 82% return over the last 5 years, significantly performing better than the close second, which is UMP, 52%. Now, whilst I always say, essentially, Historical information isn't an indicative of future performance. It is something just to bear in mind, and hopefully for those CP investors, it is something that will continue in the near future. Now, institutions, as we can see here, hold around 67-68% of the company. Now, buying and selling is what we like to see. So total outflows, the amount of selling the institutions have done, just shy of 5 billion over the last 12 years, as we can see across here. But interestingly, inflows and institutions have been buying around 10 billion. So institutions are significantly more buying shares of Canadian Pacific than they are selling. So again, interesting to note the trends that we are seeing here. Now, in terms of the dividend safety score, 76, making it safe. Market cap around 67 billion, making it a large cap company. Now, in terms of some key metrics, especially for those who believe we're heading into a recession, the last recession period, 07-09, they maintained the dividend. Recession sales, negative 12.8%, but bear in mind this was the average growth of companies in the S&P 500 during the 07-09 period. But a recession return, it did underperform the S&P by negative 64% versus negative 55% in 07-09. So just a bit there to digest for those investors who do believe essentially that a recession is looming. Now, they haven't increased their dividend, as we can see here, since 2020, so do bear that in mind. However, the last 5 years, compounded annual growth has been 12%, the last 20 years, 11%. So when you essentially couple this with the return on investment, as we saw over the last 10 years, it isn't the worst, but it would be nice to see some dividend increases. And as I always say, do bear one thing in mind, if it isn't increasing it at all, you are getting less than the inflation rate, which I always say is 4% every single year. So if you're getting less than 4% in your dividends, other income producing assets, or essentially salary, you are losing your purchasing power and taking a pay cut. So bear that in mind. So dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. 0.8 versus 0.85. You could argue this is reasonable valuation, but again, as always, we never look at any model in isolation and we'll draw a conclusion towards the end of the episode. Forward PE 23.4 versus 22.1, again fairly in line with the 5-year average, another sign of undervaluation. And we can see the PE at 23.4, higher than the sector PE at 17.4. Now, as I mentioned, whilst it is towards the 52-week low, do bear in mind if it was at the 52-week low, that would not signal undervaluation. Likewise, 52-week high would not signal overvaluation. Earnings versus free cash flow. Regular subscribers know we don't look at the earnings. We tend to ignore it. It is susceptible to manipulation by management through accounting. And for those that have seen quite a lot of videos, we do run through some examples from some companies just to show this clearly. So free cash flow, 60% and below is what I like to see. It means that there is room for management to grow those dividends double digits that we do love to see as investors. Over the large part, in fact, it has been well below 60%. So it is a bit of a surprise that they aren't increasing those dividends year on year. What we can, in fact, see, 2022, 27%, 2023 expected to be 25%. Now, again, earnings per share, the metrics are there for investors that like to look at that data. I'll draw your attention to the free cash flow. 82 cents in 2013, 278 in 2022. It is going in the right direction with 2023 expected to be 3.08, but not as consistent as maybe we would like to see in terms of regular increases year on year. But bear in mind, whilst it is an inconsistent company, it is moving in the right direction, which is positive to see. Now, as I mentioned, 3 to 7% growth is what we like to see year on year. And we can see for the large part, in fact, it has hit those metrics. There is 2016 and 2020 where we see negative growth, but over the long period and numerically speaking, 6 billion of top line sales in 2013, just shy of 9 billion in 2022. So we are seeing around a 50% increase on the top line over the last 10 years. Positive to see, but again, you're not investing in a company that has a massive growth year on year. Now, this picture tells us two stories. Typically, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. What we can see, 2013, 883 shares outstanding, 2020, 680. So the company was doing share buybacks, which is positive for investors. But in 2020 to 2022, we can see they do the opposite, where they issue shares and essentially dilute your position as a shareholder, and in fact taking it above to what it was in 2013. So a slight negative, and as I always say, if they've done this once before, they are likely to do this again in times of need. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. 10% plus is what I like to see. It means management are able to effectively allocate their capital. Now, this is a bit of a worry for me, 13 to 17% from 2013 to 2020. It did take a massive drop in 21 and 22, so I would like to see this go back above 10%, as it is a slight worry and doesn't give me a lot of faith about management if they are going down into single digits, especially when the prior history has been very good. Operating margin, free cash flow margin, not much to say other than very, very strong. Whilst we look for over 12%, they have been consistently well above that and in fact increasing. The higher the operating margin, the better for our shareholders. It means the bottom line net income should be higher and therefore leading to dividends and essentially dividend growth. Now, when we look at the right, the free cash flow margin, a very similar story. And however, the last 2 years have been phenomenal in terms of that free cash flow margin. So very positive to see, no worries with the margin themselves. Now, net debt to earnings for interest, tax, depreciation, and amortization, it was a worry, something I flagged in the balance sheet review. The reason for this, they were increasing that debt quite significantly and far outpacing the increase in cash. 3 is the maximum we look for, the number of years it would take the company to pay off all their debt net of cash on hand. Whilst it's been below that up to 2020, we do see it go quite high in 2021 to 4.99, possibly why they haven't been increasing those dividends. Whilst it has come down in 2022 at 4.39, it's still above what I like to see. The only positive here is it is expected in 2023 to be around 3.26. Again, don't forget this will affect that all-important dividend safety as well as that dividend growth. On the right, just showing the percentage of a company's financing from equity as opposed to debt. Now, in terms of the valuation model, and as always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe and bell button if you want to be continually notified of these videos as they drop. And if you want to grab a copy of the valuation model, do click on the pinned comment below where you can get your own intrinsic value for Canadian Pacific as well as other companies in your own portfolio. Now, the first company or the first valuation typically that we would use is essentially Graham's formula. However, for companies that do have faster growing revenues, it is something where you could essentially remove from the intrinsic value calculator. And in today's episode, we will not be including Graham's valuation, but just to run through for those that are interested to see how it works for the newer viewers. Earnings per share, $3.39 with a stock ticker symbol at CP. We have the growth rate per analyst estimates, current yield on AAA corporate bonds, as well as giving us our intrinsic value of $50. However, as mentioned, we're not using this model. So the first model we're using is the multiples valuation model. Companies in a similar sector and size, all of which we've reviewed on the channel, so do go check them out if you want to see them. Norfolk Southern, Union Pacific, Canadian National Railway, Old Dominion Freight Line. As we can see, their stock price, earnings per share, P multiple, we get the average, multiply by that of the EPS of CP, and get a stock price of $77 for Canadian Pacific. Now we can see that's around 10% upside to the current trading price, below the 52-week high, again showing signs of undervaluation to the company in the current market. We then move on to the second model, the dividend discount model, and whilst you may see the growth rate slightly different year on year, these companies are paid out dividends in Canadian dollars, so this will be the FX changes to the USD comparison. But the average growth rate nonetheless in Canadian dollars is around 11 to 12%. So forward looking, I have estimated around 7.25%. I would expect them to start increasing those dividends, especially with that very low free cash flow payout. However, as always, though, if you want to justify a lower or higher, depending on your own essential investment thesis, do grab a copy of the model to get your own estimates. However, based on this, we get a DDM price of $82. As we can see, some nice upside to the current trading price, around 15%, slightly lower than the 52-week high, but again showing signs of undervaluation in the current market. We then move on to the third and final model we're using, the DCF model with the free cash flows year on year. Average growth rate around 16.7%, with analysts estimating 16% forward looking alongside that discount rate. We get the present value of future free cash flows and terminal value. Add the cash, subtract total debt, get to our equity value, divide that by the shares outstanding to get a DCF price of $89. As we can see, that's slightly higher in fact than the current 52-week high, higher than the current trading price, showing severe signs of undervaluation in the current market. So the intrinsic value is essentially the average of the three models we've just watched. And again, if you do enjoy the content, value is being provided. It helps the channel astronomically if you smash the like button, subscribe if you want to have more videos of these drop to your doorstep by hitting that bell button. So intrinsic value coming to $83. Now, margin of safety, typically I would say 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. But again, you could, in my opinion, justify higher than 10% for this company. If you were looking at 15%, your acceptable buy would be around $70 to $71. If we take a look, that is still within the 52-week range. Personally, for a company like Canadian Pacific, I would say a margin of safety of 20% would be justified, meaning a buy around $66. Now, when we take a look, that is essentially slightly higher than the current trading price, but it really depends on your margin of safety. Now, as I mentioned, it is below the 52-week low, but again, it does depend. Personally, my thoughts on this, when we do take a look at essentially their competitors, my personal preferences, and again, full disclosure, I hold Canadian National Rail and Union Pacific. For me, the long-term aspects of these companies far outweigh that of Canadian Pacific. And again, if you want to understand the reasons why I believe this, I have recently dropped videos on both of these. And as I mentioned, I do hold them. Canadian Pacific isn't one that I really would be looking to hold unless it really went really low, around 20% or even 25% margin of safety. However, as always, let me know your thoughts in the comments below. Are you looking to buy Canadian Pacific, looking to sell, or purely on the sideline speculating? Wall Street do, however, believe the price over the next 12 months to go way higher than our intrinsic value to $89, so they do believe it to be a strong buy. As always, if you do want to grab a copy of the model to get your own intrinsic value of Canadian Pacific, or even companies in your own portfolio, do click on the pinned comment below. As always, have a great day. Don't forget to like and subscribe. Catch you on the next episode and take care.